Today is David Soloff, the founder of OTT Risk, a startup building technology to support the underwriting of business interruption insurance. Previous to OTT Risk, David was the founder of Premise, a collector of ground truth data where he remains chairman, and co-founder of MetaMarkets, acquired by Snapchat. David serves on the advisory board of Columbia University's Institute for Data Sciences, was a punk rock musician in the 80s, and almost got his PhD in Mediterranean archaeology. David, welcome to the show.
Thanks for having me.
So the first question is, the big premise behind OTT Risk, which is it's a subject that I'm fascinated by, is to push for more insurance, so businesses to purchase more insurance coverage. And this suggests that there's an underconsumption of insurance coverage, else why would you try and do this? Or at least an underconsumption of business interruption insurance, though I'd say that surely this would apply to other areas of insurance as well. This perhaps your model for this. So I'm wondering, what is your general model for why insurance is underconsumed or why there's an opportunity here?
I don't know that it's underconsumption of insurance. I think it's maybe misappropriation of cover. That's one way to look at it, as in,
Okay.
are the right things being insured? And are the things that are being insured to the right degree? So maybe it's more of a reallocation approach that is required rather than people ponying up more or spending more, right? So if we think about insurance kind of more broadly, and I should, caveat, I'm not an insurance professional, though I do, play one for the purposes of podcasts and my day job. I'm a technologist and I like to think of things in terms of systems. And what's so interesting is that when you look at insurance, it's actually a very elegant and wonderful invention and a really important one. And if you look at its origins and what it grew up doing and supporting and why it emerged, it was a physical set of risks that were being approached, right? It was basically ships and cargoes going across the Atlantic or going around, Cape of Good Hope or Cape Horn. And, these cargoes were precious, the ships were precious, human life not so much. But you had, the capital providers behind these expeditions, like wanting to essentially swap risk with each other, basically build a portfolio of expeditions and good transit routes. Fast forward 400 years, and the idea there is more important than ever. I'd argue that the physicality of things is much less important than it once was. So if we just think about things like GDP is going intangible. Value is intangible. What businesses do and how they earn money, yes, it may be physical, but it may just as well not be physical. So as a function of that, one would think that insurance should be able to facilitate increasingly intangible types of transactions or business arrangements. It's not the case. It's still really overly focused on what it's historically been focused on: a burning building, a smashed road, an earthquake crushing a car, a windstorm ripping off the roofs of houses. Those are all really, really devastating and important events to cover. But the question becomes, given a finite pool of premium and a finite pool of capital that can backstop risks, how much of that should be covered vis-a-vis the emergent kinds of risks that businesses right now have kind of been silently carrying, right? So a political action, a civil action, a reputational hit, a cyber intrusion, a government lockdown, some of which or all of which might be spurred by some kind of physical event up front, like a catastrophe or a terrorist attack or a bomb. However, the kind of secondary and tertiary loss is intangible. Hey, my business is not operating, my revenues are taking a hit, I have to lay people off. My business and my inventory might be completely intact and untouched, but the reality is that I'm suffering a lot of damages and loss. So that's kind of what I mean by misappropriation, or maybe it's maybe it's sort of a redefinition is kind of in order. And I'm wondering whether the pandemic and the way business interruption claims are being contended in courts in various places is going to force a reconsideration of things. We've got our own point of view on it. So, um, with that said, like, I don't think insurance is being underconsumed. I think it's underperforming in the way that it's supposed to, right? I think that, again, to take the pandemic and look at like all of the property and casualty policies that have been in effect for businesses in all of the affected geographies around the world, a lot of these people thought that they had business interruption cover embedded within their property and casualty, and only to find that, well, no, actually, guess what? You're not covered in the case of some sort of force majeure or government event. And no, you haven't been paying premium. Had you wanted that, we wouldn't even know how to begin underwriting it. And no, you don't have it. So that's a problem. And then you've got sort of the punchline of the joke, which is that, and I'm not taking this lightly, nor am I making light of it. It is a little bit of a punchline, though, or kind of like a cruel hoax, which is what regulators are doing in the UK and what they're going to increasingly do in the US, which is now make the insurance companies pay out on the BI claims that they never collected premium on in the first place because it's such a sort of publicity catastrophe and the public is up in arms about it. So you've got kind of a little bit of a circular firing squad going on here. Um, so I guess we have the good fortune of kind of coming into this with a clean sheet of paper and just thinking, okay, if we start from the supposition that these kinds of systemic, nasty, hybrid physical, non-physical trigger events are going to happen more and more. And even since COVID, we've had Texas, freak winter storm grid failure. That's another one of these kind of weird systemic things. In the face of that, you've got sort of political gridlock and policy response failure. You've got new classes of risk that are impacting businesses and individuals in really profoundly different ways. We've got to attack this very, very actively and very aggressively, and maybe reallocate how the capital is being backstopping.
Yeah, man, lots there I want to talk about. So
Sorry,
you've succeeded in previewing the entire. No, but I mean, it is a very rich topic. A very, very rich topic, because anytime you get an innovation insurance going on, right, there's going to be some underlying theory for a market failure, right? Or at least, the current allocation of resources is not optimal, and we want to bring a startup along to change things, something underlying, it's the typical startup stuff that happens everywhere. It happens in insurance. And I'm just fascinated by digging into kind of like some underlying hypotheses, let's call it. So you're saying reallocation. And the reason why I brought up this sort of underconsumption idea is this white paper, or one pager, actually came across on the internet, which is this pretty cool publication that Chamath sent out over Twitter, at least. That's how I came across it, about your business plan. And in it, there's this reference to $20 trillion of economic loss because of COVID. And the current capitalization of the insurance industry is like, or the current limit outstanding of the insurance industry is about 100 trillion was an estimate, which, I mean, who knows? That stuff is hard to tell, but it sounds about right. The relative kind of magnitude, I think, is on track. And, if you take 20 and you add it to 100, if I got the numbers right here, now it's 120. But maybe you're saying that 100 should go to 80. Maybe there's a reallocation that should go on, and we're insuring the wrong stuff. We're pointed in the wrong direction, and then we should shift that around. So maybe you could kind of help me with that.
Yeah. Good. So maybe let's press on some of the terminology, because that might help us.
Cool.
So what you're describing in terms of a coverage gap, there's two different ways to slice this, and maybe it's a bit of both, not to hedge. You've got an undercapitalization problem,
right?
As in there isn't enough money set aside or denoted to support these losses in the eventuality that they occur. That's one thing, right? And then I'd argue kind of the others. I guess if I think out loud, if you think of it in terms of a market structure, there's equally a lot. So if that's the supply side of things, there's also a demand problem. And that maybe is getting at what you're talking about with underconsumption, right? Like people, businesses, whomever, insurers, reinsurers, they don't know they need this, or they kind of know they need it, but they don't know what to call it or how to bound it, where there isn't a mechanism that makes it consumable, and they're all bearing it silently or frankly not so silently. Um, and so, maybe people know they need something, but they don't know what it is, or they don't know if there's anything in the offing. And so they can't consume it because they're not being offered a tool or an on ramp for it. So you've got almost like an isometric problem where you've got an inability to coalesce demand, maybe because of a lack of definitions or structures or analytic mechanisms or pricing mechanisms or market mechanisms. And then I think either as a function, but also as an aggravating circumstance, you don't have a ton of capital that's dying to solve this problem because it doesn't know how, doesn't know what the economics of it would be, right? So I think that's maybe a backdoor answer to your underconsumption problem. And it also talks a little bit about, well, things like misallocation and inefficient market structure with respect to this. And also how, and this is something where, this is a slam door we're running right into. How do you even innovate in the insurance industry if it's not, the only innovation that seems to be permitted in many ways is cutting costs on the delivery or on the underwriting side. It's like, it's an industry that is, obsessed with deploying technology to do things like minimize fraud, minimize basis risk, reduce the margin around delivering a policy or delivering benefits. And those are all important things, but it's sort of like it's like a wish sandwich, it's like two pieces of bread, but like the real opportunity is like the protein that isn't there. So like, so that's kind of how we're tackling it, which is like, yeah, all of those delivery and kind of risk scoring models for known problems, those are all very, very important. Or even user experience, those are all important from a consumer's, how many comparison engines are we going to have already? How many like instant underwriters on the phone for your crap on your shelf are we going to have? Like, can we get at the real problem here? Which is that like, the social and commercial fabric of like American cities is being completely eviscerated, and there's zero credit or insurance mechanism to fill that gap. Like that strikes me as a much bigger problem than, some of the issues that technology is being pointed at right now. I'll get off my soapbox.
No, I mean, I love it. I mean,
four different answers. Sorry, man.
No, this is great. So let's kind of keep coming at it. You referred to both possible forces, supply and demand, right? Is it a problem of supply? Insurance companies don't want to give it, or is it a problem of demand? People don't want to buy it, right? So what is the missing piece here? And I think a lot of people are very quick to point the finger at an insurance company and say, you don't want to sell this. And so, right. And so that's where the kind of market failure is. Yeah. But, I'm a little biased. I haven't been in the insurance industry for a long time, but never worked for an insurance company. So maybe it's not quite so bad. But I think that the modal failure of insurance innovation is complete non-consumption. Like insurance companies, they actually produce new products frequently enough, small little pilots and the like, and basically nobody cares. And I think that the model that I like to invoke for why that's the case is to observe first that the vast majority of insurance is compulsory. You don't have a choice, right? So auto insurance, most property insurance is enforced by some regulatory entity or by a mortgage company or something like that, right? And nobody wants to buy it because for a variety of reasons. I mean, for auto insurance, you're not protecting yourself, you're protecting the person you're going to hit, and you don't think you're going to hit anybody. So like, I'm a good driver. Why would I ever want to buy auto liability insurance? Goes a simple chain of logic. And for that matter, in property insurance, it's my house. And a lot of people who don't have a mortgage are underinsured because the bank doesn't force them to buy insurance. So they don't buy insurance, and then they have a big problem. But they have no wealthy enough to own a house outright. So good for them. Maybe until a disaster hits. And so I think that there's and this aligns with a lot of literature on cognitive bias, right? So we have a kind of like a pre-wired weakness for thinking about the kinds of things that insurance protects us against. We have availability bias, we have overconfidence bias, we have all these things that makes us not realize that the risks are out there, and so we underestimate the risks that exist. And along comes the government, which is an interesting evolution of itself, because we're voting for people to tell us to buy insurance, but we do. and the government says you must buy it. And so I would imagine, if that's true, and very interested in your thoughts on this, if you've thought it through, that the best way for you to reallocate the consumption of insurance is not by convincing businesses to do so. It's by convincing the regulator or the government to say, you're going to have to rewrite the accepted language of an insurance policy, which is approved by regulators, to force people to buy this cover over here. And then everybody goes along for the ride. What do you think?
It's a possibility. I mean, it's what's happening in the UK right now, right?
Right.
You know, the regulator there is, you know, they're engaging in some preliminary actions where, you know, they're going to effectively force property and casualty products to embed or supply or answer for the kinds of business interruption scenarios that we've seen with COVID. And, you know, it's going to be a tax that is borne by, you know, the buyer of the insurance. They're going to have to buy this cover embedded, and it'll be, you know, the surcharge, or it'll be an upcharge. And yeah, hey, your policy has new features, you know, click here to learn more. And oh, by the way, you know, it's, you know, we're adding 7% to your premium because you've got this, you know, souped up BI. That's, you know, a very sensible way to do it. Not that I'm, you know, a fan of regulation in that regard, but like to your point, there are all sorts of cognitive biases, and insurance is an unpleasant thing to consider because you're necessarily considering, you know, suffering a loss or failing, and, you know, nobody wants to buy for that. With that said, you know, I think what we've seen, and, you know, how markets harden and new products get born and gain traction is off the back of previously unanticipated or unmodeled or partially unmodeled and fully unreserved events coming to pass, where businesses, you know, a grocery chain or, you know, global, you know, a multinational corporate, they're now suffering losses within a scenario that will remain rather fresh in their minds for 1, 2, 3 years in the immediate term. Okay, so here's your window. There's a host of problems, but if there's ever going to be a time to kind of make manifest why a product like this and cover is important, it's right now. You have to design the product such that it actually fills that coverage gap and supports a business or a group of businesses or an individual even getting from point A to point B until things normalize or stabilize, or until a government entity or somebody can actually support on a more sustained or ongoing basis. That's certainly not going to happen here in the US. I mean, look at, you know, how long it's taken Congress to get to a COVID relief package. And yes, people are going to receive, you know, direct payments from Treasury, but those will go away. And at some point, enhanced jobless benefits will go away. And businesses themselves have actually been hosed. I mean, they haven't really gotten what they've needed at all if they've survived this long. So right. I don't think relying on the public sector or even thinking of the public sector here in the US as an alternative or a partner in this or an immediate stopgap solution is feasible. I mean, one could argue that FEMA should have stepped into the breach in the way that they would have in, you know, a massive flood. That would have been, you know, that's the government agency we seem to have here in the US that actually, you know, steps in and fills that gap. There's an emergency declaration of some type, and, you know, then that releases the funds, and the president does his flyover in a helicopter, and then, you know, you've got like people lining up for benefits and, you know, cover, and, you know, they help filing insurance claims and jobless claims and all those things. That hasn't happened here. So that's, you know, I guess that's another, it's an adjacent topic and a quite interesting one. So to your point, I think that if there is now the opportunity to, you know, take current situation as an object lesson and to present a product in the context of what businesses already buy or are required to carry, and we can economically present it, and they can, and the consumer of insurance can be assured and reassured consistently that no, what just happened will not happen again. Namely, insurance will not pull up the stakes and argue the claim against you. but in fact, this product is designed for precisely these circumstances. And yes, it costs X% more. You still have another problem. So you're now progressing towards a solution, but now the problem becomes the entity that is most likely to buy it is going to probably be the one that least needs it and can most afford
Sure.
it.
Often the case.
Always the case. That's always the case. The people who need the insurance most are the ones who don't have it.
Yeah.
And
And the ones who don't need it are the ones that's easy to sell to because everybody's
so
okay with that.
do you use foul language on this podcast, or is this a family?
Go for it, man. Nah.
At that point,
Kids
I
don't
don't know
listen to
what
this
the
crap.
fuck you do. I literally don't know what the fuck the answer is there. I think that so I got a couple of ideas or guesses. Um, uh, you know, the grand, you know, if I haven't lost, most of your audience, this will probably this particular mini monologue will probably drive the rest of them away. So I apologize.
As long as it's controversial, David, then
It's
I'm
not
happy.
controversial. It's just like it's like preachy, maybe. Um, so when we get to that segment of the market that we're talking about, and those can be classes of businesses or geographies, they're the ones that most need it. It's like going to be someone who owns a restaurant or a retail outlet, a store in a small city or small town. It's going to be a local business person who has been cut to shreds by this. They don't have BI cover. Their businesses have been shut down, and like they're laying people off, and this is happening again and again times 100,000. So how is cover brought to those individuals or those businesses in the circumstance where, yeah, you got an analytic mechanism and you may even have government capital, but there's zero political will to actually bring it to bear? I'd argue that PPP was an attempt to, bridge its business continuity cover. It was a way to try to make sure that people who run businesses had enough capital coming to them to support payroll until they could get to the other side, whenever that would be. And that's what insurance should do, right? So the question becomes, do you have the political will, the analytic framework, and the capital, public and or private, to form a pool or some sort of facility, as has been done with things like terrorism or flood or earthquake here in California or elsewhere, where when there is a force majeure lockdown that causes broad-based economic devastation, is there a pooling mechanism that brings low or no cost subsidized cover to small business people or mid-sized businesses within a region? That to me isn't nice to have. That is critical. I mean, it's totally, unless we want to go to a universe of super endowed, massive, sort of monstrous global corporations and nothing else, and people, baking bread in their kitchens. That's where we're heading at this point. You have these monstrously well capitalized companies that can borrow at basically zero cost, can sell equity at inflated prices, and can borrow and sell convertible, debt. They're able to capitalize their own way through any sort of dislocation, and they just get stronger. They eat everyone's lunch. For those who can't afford the capital, those are also the people who are not being insured. So, it's so what do we do, right? As a company that's trying to build a scalable business with favorable unit economics, we've got to sell some product to those big corporates. They deserve cover for continuity just as much as anybody else. But can we use that mechanism? Can we take the premium flows? Can we invest them in such a way to generate outsized returns? And can we then use that to buy down or subsidize the cost of cover for mid and low end of the market? That becomes a really interesting business model question for us. And it's one we're actively engaged in thinking through.
That's pretty interesting because I'm struck by the we're talking about small businesses. I mean, nobody's gonna argue with the point that hosed. I think it was the word you used, and you could get more colorful than that. And I think, though, an insurance salesperson, of which I have been, would say to you, well, I agree, but I tried to sell them the cover last year and they didn't want it, right? And then, they want something for nothing, right? They want the bailout deal. They want the one where the government says, you didn't pay for anything last year. Me, with my infinite credit, U.S. government, new treasury, can just start pouring money all over everybody. after the fact, because after the fact it's obvious, right? We were starting to have this conversation. We're at, kind of nearing the end, let's hope, and I believe of the COVID pandemic. And now we can look back and be like, we were nuts. Why didn't anybody buy any pandemic cover of any sort? And it's because they wouldn't have bought it, right? They would have said, why am I, imagine if you put some legislation forward a couple of years ago. And by the way, the government has been kind of stripping away a lot of its pandemic relief. The government has actually had reserves of a variety of things, masks and all the rest of that, and they've gotten rid of it after the Asian flu, the SARS version 0 and 0.1, 10, 15 years ago. They got rid of all those stores, and so they're actively uninsuring or de-insuring our society against it. And this is the organization that's supposed to have unlimited resources, right? And yet it's still constraining itself. And so, like, my story for that, and you can tell me what you think, is that people just this is like this kind of like risk assessment kind of flaw that we have. And here's a sympathetic story. My sympathetic story for that is risk is infinite, David. Like, so we're talking about pandemics, but what about asteroids? And what about, like, we don't have any Star Wars defense program, and, on and on the list can go of things you could imagine, which would be really bad. And out in the tail, there's a whole bunch of stuff that could wipe us out that we can't insure against everything. And so, you kind of have to draw the line somewhere, people might say. And where and how should you think about drawing that line, except to say, look behind you and say, well, what's happened in the last 15 years? I'm going to worry about those risks.
Yeah, I think what you're describing actually is just late stage capitalism. Which is like, where the answer is just fucking deal with it. Like, like literally, it's like it's vicious. No one's going to help you. You better have some mechanism to acquire the capital you need, but we're not going to give it to you. You're too stupid to know that you should have this cover. No one's taking the time to explain it to you. You're not going to buy it anyway, even if you understand it, because you're going to convince yourself either one, it's not going to happen to me, or two, if it does, the government's going to bail me out, because they bail everyone out, don't they? Well, no, they don't. They only bail out a narrow sector of the economy and the market, actually, and we're seeing that right now. But everything you're saying is right. Risk is infinite when you take all risk. But some risks are not, some risks are actually, I won't say they're known, but they're not infinite. There's a quantum there, and there is a way to measure it. Especially,
and we haven't even talked about OTT risk is, and maybe we should do that. Maybe you can tell us, like, what is the.
We're talking about it. We're talking about it right now. I mean, like, this is the argument I have with myself and with my colleagues and investors all the time, which is, are people actually going to buy it?
Yeah.
And like, and or do they need to be forced to buy it, or do they need to be sold it without knowing they're buying it?
But in your case, like, what was very interesting about your business model, as I understand it, is that you're actually kind of taking a pretty narrow slice out of this, which is to say, we're going to work on analytics platforms, which ties into your personal history, which I'd love to get into as well as background for this. But you're saying, let's get the data and the analysis together to understand the risk better, and use that as kind of our point of leverage in which to try and create change around us. So you're not boiling the ocean, right? You're trying to be focused.
No, I mean, absolutely. We don't have enough capital at our disposal to boil the ocean and try to insure the ocean. I mean, we're just using a technology-driven approach to taking a seemingly infinite risk and identifying slices or tranches of it or factors of it that will impact an insured or cedent adversely over some period of time during the policy period. We're looking at our historical models to assess how frequently certain classes of named trigger perils have happened and what the macro and microeconomic impacts of those dislocating events have been. And then we're also adding a hybrid layer to the model, which is understanding that historical models are necessary but not sufficient. We're also then looking at the current volatility regime for those risks that we believe we're operating in, and we make a calculation and we say, hey, for $2 million of business continuity cover, and defined in some more specific way that I won't go into now, we will serve as your counterparty. We'll make you whole, or we'll make you partially whole, depending on how much you want to pay in premium. And here are the parametric triggers that we are agreeing upon to structure around. And it will be evident to us whether there are breaches, and we'll make you whole. And it's our belief that based on the analytic enterprise we've built, that what we're effectively doing is identifying business interruption, non-physical damage business interruption scenarios for your business in your geography for a given time frame. So it's not us trying to backstop the system. It's not us trying to backstop the industry. It's us trying to backstop either an insurer who's delivering an insurance product with an enhanced or embedded BI cover to a specific customer, or us going directly to the corporate and eventually the SME and serving as their counterparty. And rather than trying to generate a lot of enthusiasm among capital providers or public sector agencies for the approach, we're bringing our own capital to it. So we'll serve as the counterparty. We're confident in the approach, and we want to hold the risk. We think that there can be a profitable trade here.
And so, like, what I also want to touch on too is your own background here, right? Which is, this is again, there's a theme, and in my research, I kind of have seen, and you've also articulated a pattern in your own personal professional development, which is about finding data that can help with kind of messy problems.
Yeah.
Right. So maybe you can talk a little bit about the context here. So maybe go back to premise and maybe meta markets a little bit to sort of say, how else have you approached this kind of challenge in your career?
Yeah. So I don't know if it was you I said it to, or maybe I said it to myself in a dream. But if you're lucky, you get one good idea or concept in your life, and like you spend your whole career just iterating and reiterating and just trying to get it right. That definitely is my story. I've always been interested in things that are hiding in plain sight and harvesting information that is, right in front of us or flying past us in order to make evident these things and do something with them, either risk manage or profit or make better decisions from them. I mean, if I had to put it down to a word, it would just be indexation, right? It's this, which is a really elegant and kind of wonderful, amazing set of businesses that can get built around it, and a set of exercises that can get built around it. In my
What
case,
is indexing? I'm not sure I understand the kind of the
just
metaphor
indexing
there.
as in taking a bunch of disparate or even related data points that could be transactions or prices or responses to a question, taking them and collecting them over time and aggregating them in meaningful ways such that you are using the delta or change from one point to the next in that set of answers or aggregated answer to tell a story about how things around the question are changing and how people's relationship to the question or the transaction is changing, right? So an example of an index would be a stock market index, right? It's a single number with a change that people use as a real shorthand, which serves as a proxy for a whole host of things. It's an amazing leverage point. Like, it's an amazing intellectual leverage point. And then you can do all sorts of derivative things off of it. You can tell all sorts of stories, or you can build a whole narrative around it. You can make this mistake of causation or correlation with it, and you can do all sorts of things. So all of the businesses that I've started have related to that in one way, shape, or form. But I've always wanted to get to the point where I hope we get to with OTT, which is risk management and using this indexation approach as a mechanism for navigating increasingly turbulent times. And yes, someone involved in that transaction might be doing it to make a profit, but someone on the other side of that trade hopefully is deriving a more significant benefit than profit, as in maybe they're getting paid out when they need it most. So when people, bet on derivatives or use derivatives in the financial markets, there are all these different motives that are behind people's decision to participate in those markets. Some of them are out of necessity, as in they're operating a business and they fear they're exposed to a surge in raw materials costs that would be catastrophic for them. They have no choice but to essentially buy protection in the form of a derivative. On the other side of that trade, there might be the sharkiest of sharks who are selling that cover, and their only motive, they could give a rat's, nose about who's on the other side of it. They just like the price. That's great. I mean, if that's a wonderful situation because both actors are having their needs met in that regard. So, but in order to let these really strange bedfellows come together, you need to have a common mechanism, a common analytic framework, and a common understanding about why the index works, what the components of it are. You need to have some confidence in it. There's a really smart guy that I had the good fortune of talking to a number of years ago before I started my first business. His name's Peter Borish, and he's one of sort of the godfathers of quantitative trading. Um, he he worked for he was head of trading at Tudor for a while and has done all kinds of systematic trading on Wall Street. And I was talking to him about indexation in connection with my first business, MetaMarkets, and he had kind of three rules of thumb regarding the utility of an index. One, he said, is it needs to have utility. It needs to be useful. Nobody wants an index around that's like cool, but actually not useful. You need to make a very cogent argument for why it's important and how it relates to things in the actual world. Business decisions you're going to make, investments you're going to make, something. Risks you're going to cover or hedge away. Two, it needs to be transparent, but not so transparent that someone could reverse engineer it. So it needs to be transparent enough that people can understand how it's made. They need to have confidence that it's being made the right way, but it still needs to have some special sauce with respect to the aggregation and collection of it, or you need to be protected by trademark or patent. Or it needs to be adjudicated by a nonprofit public domain entity like the World Bank or the US Treasury. And the third is that it needs to be repeatable. People who are going to bet their livelihood or use this as a tool, they need to make sure that it continues on, that it doesn't go away the next day or the next month or the next year. So I've always kind of kept those things in front of me. I've memorized them, right? And because I think they're really good rules of thumb. So to bring that back to OTT, in the case of understanding what business interruption risk is, we focused around not doing the indexation, but rather coming up with an analytic framework such that we can use indexes that are in the public domain or that are out there, that not that we're collecting and not that we own, but we're using them and we're back testing them one against another through different categories to narrow down the risk, to narrow down the basis risk of the risk that we're going to take on behalf of a business or a corporate or an insurance company. The other businesses have focused on things like indexing transaction data for the media markets. With MetaMarkets, what we built was, I had this grand vision that we were going to build the Bloomberg for the digital media ecosystem. This was going back to the late 2000 aughts, and everything, all advertising dollars were moving online. It was a very, very lumpy kind of arbitrary mechanism that was used to price ad spots across all of these digital properties. There was no kind of data hub for any of it. And so I thought, hey, what better way to risk manage and to enable different parties in that market to risk manage and to hedge? There's no better way than creating a data hub or a data bus for all this transaction data. And if we could somehow compel all the different actors to supply their transaction information, then we'd be able to create a data utility. And then we'd also be able to build derivatives off of it and let people risk manage, right? Familiar, same idea over and over again. Well, we didn't even get close to doing that.
Why not, you think?
Well, I mean, I could go into a lot of. I mean, there's lots of different reasons. The answer that's most fit for the current audience consumption. I have a whole riff I can go on about co-founder risk and investor
Uh,
risk and market risk and doing this, but the, I think all of those things were exacerbated by the more fundamental risk, which was I was trying to answer a problem that the market really didn't perceive as a high value problem yet,
Interesting.
and where there were much bigger problems to solve first. But I was so
Mm.
in love with the idea that I didn't see the risk inherent in trying to push on it. And I wasn't content with giving the market what it was asking for, given the technology we had built. Ultimately, we did, but there were a host of painful lessons we had to learn in between what we wanted to build and get into the market versus what the market was going to value and reward us for. And that's more about like entrepreneurship and startups and
Yeah,
all.
because if I could dwell on that just for a second, because I like this. There's an interesting juxtaposition. I don't know, tension. I don't know what the right metaphor is here, but the you're clearly a passionate guy, right? And that's the sort of thing that gives you the energy to start your third startup, David. My God, very impressive. And yet, I think what you're illustrating there a little bit is there's a little bit of a downside to that, which is you can get a little bit, overly committed to something, right? You fall too
Oh,
much in love.
well, you have to be. It is it's the true definition of a two-edged sword, right? Which is that
Sure, right. Better
you need
word
to be
for it.
so optimistic and so passionate and so stubborn and so embracing of risk, almost to a psychotic level. Um,
Oh gosh,
that
man, it's terrifying.
well, it's funny. I mean, I don't. Do you want to talk about entrepreneurship?
Let's go, man.
We
Yeah, sure. I
only
mean, shoot, like
we only want to talk about
how
insurance.
risky is entrepreneurship? Because here's something the audience is going to be thinking about here, right? Let's because as I kind of mentioned to you when we were kind of setting this up, the audience is predominantly insurance veterans, and I know one of the interesting things you've done is you've talked to a bunch of insurance veterans in developing the business plan and the model for your company, and so you're interested in that kind of like real feedback. And some of the people are going to be sitting in the audience thinking, dismissive, right? They're going to say this guy, blah blah blah, doesn't really know, and there's a bunch of things that you could point out little flaws and the like, but that's not how you innovate, is it? Right? The way you actually bust through these problems is you have the passion, you have the drive, you know enough about this to realize it's not like completely insane, or I don't know, maybe sometimes it is, but you got to push through it, right? And so actually, you being on this show is an enormously encouraging, I would say, if I was investing in your company, sign because you're trying to figure it out. You're going to sit outside with
Yeah,
this guy you never met, an
yeah.
actuary, and he's going to grill you for an hour, and you didn't know anything about me, and here you are. And so the passion's what's driving you through this.
Yes. So, amen. Um, so many things to say to that. Um, gosh, where to start? So I love being told I'm wrong, maybe the only thing I love better than being told I'm wrong is being shown I'm wrong. Um, because that's a great way to learn, and it's a way to short circuit mistakes. And like one thing I've learned, and I've gotten progressively better at over the course of my three companies, is I was very afraid to learn I was wrong early on as an entrepreneur. And that's for a lot of reasons. One, I was younger. I was,
It hurts, right? I mean, it hurts for
it's,
people to tell you you're
it's,
wrong and for them to be right.
well, it's scary, right? Because at a
Yeah,
certain point in your career or your life, you know, being wrong poses an existential threat.
right.
It can blot you out. It might be just the thing that a potential investor needs to say, you know what, we love you and we love the idea, but we just can't get there. Get
Yeah,
there is code for investors saying we're not going to back you.
right.
It's like, oh, we were so close, but we just at the end of and the reason I know this is that it's burned in my soul. At the end of the day, we just couldn't get there.
Yeah,
But we'll be cheering you on from the sidelines.
it's all the same
We
words,
would
right?
and
Every time.
we'd love to touch base with you and keep in touch with and keep on top of the progress you make.
Yeah,
And hopefully we can work together in the future, which is yeah, you know what? Sorry, dude, later. And I'm going to completely forget that I've ever spoken to you. And that's okay. You're like, all right, good. But when you're early on and you don't have any demonstrable success and like, you're working some, in my case, I was starting my companies and working as a contractor, a consultant to other companies. And it was,
Hmm.
I wasn't going to do that for the rest of my life. I had no choice, and I also knew that there was no other way to bring these ideas to life other than to start my own enterprise. And then there's like the quirks of personality of the founder, which is that like I am delusionally optimistic, um, and I do have a high pain threshold, and I am comfortable with trauma. Like these are things like there's a really wonderful investor who's like the most intellectual. I mean, if anyone were to make entrepreneurship and investment a kind of an elegant science or almost artwork, it's someone named Mike Deering who he runs a fund called Harrison Metal, and he's a sole practitioner. He's a craftsman, if that makes sense, if you can be.
Hmm.
And he's an intellectual about it. He's kind of built his own university curriculum around entrepreneurship and like the sociology of entrepreneurship and the psychology of entrepreneurship. And, he's got a whole riff that he's done about, the sort of cognitive quirks of startup founders. There's 5 qualities that the best founders demonstrate. And, he goes into some depth about it, but there's a reason why a lot of founders are from, first generation families or immigrants. There's that fear of the abyss. It's like succeed or die. They do have a delusionally large sense of their own rectitude. They have outsized egos. They're sociopathic. Like they will do things regardless of what the conventions are. It's kind of alarming to read and talk to him about this over because he was the first capital in my second company premise, and it was alarming to read. Like I was like, wow, he looking for these hallmarks in me? So anyway, there's obviously a lot I can say about it, but all of that, like, the good thing is that I have gotten more rather than less successful as I've stayed in it. And so I feel like with company number 3, I am looking actively at the very early stages to be told and shown why and how I'm wrong. I'm not afraid of it. It actually is the most efficient thing. And I may choose to ignore, just because I'm being shown and told that I'm wrong doesn't mean that I am following the advice or the input.
Right.
I may choose to actively defy it, but at least I know how and why I'm being perceived as wrong.
What was the last thing that you were shown to have gotten wrong that you incorporated into your integrated into your plans for OTT risk?
Oh, that is a great. So you're presuming that I have a plan for OTT risk.
Oh, you could pretend you did. You didn't have to tell anybody that, David.
No, I do have a plan. I mean,
I saw the one page right here.
but no,
It's
no.
good.
Hey man, I know that one pager quite well.
I'm sure you do.
Okay, so the question is, what is the last thing that I have been shown is wrong about my plan that I have incorporated into my plan? Wow. I think the idea of being an own capital provider
Interesting.
using a proprietary technical approach to carve out and push forward on a new type of standalone cover. There's 3 different things I've been told can't happen, but the one that has made the most active appearance in our business plan is raising a balance sheet to get our approach into the market more quickly than it ever otherwise would be possible to do.
Okay. So
basically, I was told by someone, don't do that. That's a catastrophic mistake. You'll be sowing the seeds of your own destruction before this product ever sees the light of day.
and you at one point had plans to raise a balance sheet, and now you're going to operate through existing balance sheets. Is that
No, no,
true?
no, the opposite.
Oh, okay.
The original plan was, okay,
To
let's be
not.
an analytics provider.
I see.
Let's be the pricer. Let's be the hub around which things get originated, but we're not going to hold any of the risk and we won't have our own capital. We'll
Okay.
just, be the arms dealer. That's the, um, and my, I've, from businesses I've started, I've learned that like it sucks being the analytics provider
Hmm.
because like you don't participate in the value you create if this thing works. You're like on the sideline, like, um, you know, being proud that people are having a lot of success, using your stuff
Yep.
and getting more and more successful, generating more and more margin or solving bigger and bigger problems. And all you're doing, and it is not trivial. It's just that I want to be a principal, and so that there's the ego involved. There's also, I think, maybe more importantly, there's the recognition that in this industry, in insurance, reinsurance, if you're not bringing your own capital, you're wholly dependent on someone providing capital to enable you to test whether your product can work.
Yep.
And that is definitely that's an operating risk. It could even be an existential risk. And if you are successful in getting that capital, it's still not your capital. It's someone else's. So here you are
Yeah.
facilitating.
There's a lot of hand wringing in the insurance business, David, which maybe you've gotten clued in on a little bit about how the pure balance sheet play is a commodity. And so it doesn't command very great returns. And so there's a sort of ever present, all the talk, let's put it this way, the insider's talk is usually about how disintegrating the value chain is actually the source of a lot of innovation. I mean, people talk about everything, so I shouldn't be too, I don't want to reduce this too much, but where you can pull out the insurance balance sheet and now you can just sort of pay them 4% or something like that, and then you can assemble everything else around it and command higher margins. So people were kind of obsessed with this. Now that is not an innovation forward plan, right? That's about extracting. It's about optimizing. Right, and you're talking about something very different here, which is like bringing something wholly new to the marketplace.
That's right. That's right. So, capital in and of itself is not valuable.
Mm-hmm.
Well, it is valuable. It's really valuable. It's as valuable
Yeah,
as,
yeah.
it's as valuable as the
Literally
capital
has a price on it, which is
plus the availability plus the cost of it. Right. So,
yeah,
um, it's one of those things that's necessary but not sufficient here. Um, we're not building an investment fund. We're not trying to evolve as an alternative capital provider. Capital is an instrument, just like technology is an instrument to bring a new product to life and hopefully have a market develop around it. In this case, we want it to be a resilience market, you know, um, because, business interruption, business continuity really is the ultimate resilience play. Um, there's a real market need and a market hunger for ESG and resilience investments. There's a supply shortfall. There's more capital that wants to participate in it than there are slots for availability. And here we have an absolutely burning need in the world for capital to support resilience at the moment when, on the one hand, government is nowhere to be found, and on the other, insurance is nowhere to be found. The insurance industry is not playing an active role, and it doesn't have an intention or a solution to do so. It's going to do so when its hand is forced. It's not even like responsive to public relations fiascos.
no,
It's only regulatory. That's the only thing that's going to get it to move.
yeah. So
Dude, that's bullshit. I mean, like that. I understand that you've got a good franchise. I totally get it. But like, seriously, there's a huge business opportunity here. It's not like I'm not a charity. I'm gonna build. We're gonna hopefully, God willing, build a high impact, very profitable technology company that brings its own capital to bear to get this kickstarted. That's the hope.
tell me where you are kind of in your developmental process right now. So like all kinds of stages startups go through. What's the kind of the problem you're focusing on right now? Are you getting customers? You ready for that? Is it just pure tech build? Like tell me where
No,
you're
I
at.
mean, we're actively building on the tech, and we've got something that works. So call it a minimum viable product. Call it
Okay.
version 1.0, whatever. you want to call it. We've got capital, and hopefully we're going to be underwriting our first transactions by the end of the second quarter. That could get delayed or it might fall through, but we're going to be getting into the market this year. Now, what does that look like? Well, it means that it's either embedded or standalone BI or NDBI cover. It means it's either insurance, reinsurance, or retro cover. It means we are either the entire or partial holder of the risk, and it means that we've used our analytic and pricing approach to support that transaction.
That's pretty exciting. What is one thing from an analytic perspective of just talking about the model? What's something in the model that surprised you guys? I didn't think this would matter.
What? How relevant history is, even to this new type of approach to insuring, and even how important and revealing history is, even when dealing with, quote, unexpected drawdowns and dislocations. That if you cast a wide enough net on the perils end, and you're looking for the right connections or correlations at the economic level, you can build a very, very powerful historical model. That's not going to be sufficient if your starting point is that things are fundamentally different and changing rapidly right now. But it is a critical input or leg in the model. What's surprised us has been how effective that approach has been for us.
And you're defining these crises generally. I mean, it's not just pandemics, right?
No.
Tell me kind of example events and what in history.
Yeah. So there's so many different ways to slice it, but I guess the easiest answer for right now, and maybe the crudest, is to say there's kind of two categories: there's included and excluded. And if you think about exclusions and perils and named perils, in the current cases being adjudicated or argued with respect to the pandemic and government enforced lockdowns, you've got a list of trigger events, many of which are excluded explicitly, others of which are unnamed but being argued should be excluded. So that's within the context of maybe two, potentially three categories: a global health event, a government mandated lockdown, and then a much trickier and more numinous and potentially more powerful aggravating peril, which is disinformation, misinformation, which I'd argue has made the pandemic and the pandemic response so foggy and so complicated and so protracted.
What does that mean? Disinformation. I mean, I understand the word, I think, but
so in a universe where people are not doubting the efficacy of vaccines, how much more quickly can you recover from a pandemic than in a scenario where 50% of the population believes that it's going to make them unhealthy to take a vaccine? Or in a world where information or misinformation or disinformation is convincing people that they should not take certain protective measures to stop the spread of a virus, how much worse or how much longer or how much greater is the burden on health systems when you've got actors and then counter actors, right? So that's I think that sort of that nexus of events and perils is increasingly what we're going to see. Right, so you've got a global health event, you've got almost out of the gate arguments and contentions about how severe or not severe this thing is, which in and of itself slows the response, but also magnifies the spread at the same time. Then you've got a very, very long stretch of time where people don't quite know whether they should or shouldn't engage in commerce and education. And now you've got sort of the third act, which is an argument or a fight over vaccines and vaccine availability. Here in California, reading the press, one would think that we had an undersupply of vaccines. Looking at the vaccination rate in the state and looking at the press cover and looking at what is being talked about online and Facebook or elsewhere. The reality is that in the state, you've got thousands of shots being thrown away every day because there are no takers, because people are being actively discouraged from signing up for slots because they believe that it's impossible to get it. So, like, that's what I mean. And then that's not even getting into who's behind that. Is that a coordinated action? Right? Like, not to sound like a tinfoil hat person, but it's been monstrously effective, whatever it is, right? So that's what I mean by that. So you've got like different levels of peril.
Can I ask you about that? Like, how do you validate that component of the model?
I have no idea.
But surely you've done something. I mean, I would think that you guys would have to, like, I mean, if you're putting it in the model, you're going to have to, put some testing to it.
It's not in the model. It's not in the model. It can't be in the model. I don't know what it is.
Right. Okay. That's what I'm getting at. Neither do I. Because, like, I'm thinking, like, I could imagine, I could tell you a story, David, for how that would contribute to a pandemic, a story that I would even believe. But can I go back in history and say, well, if the 1918 flu had more disinformation, how much bigger of a loss would it be? Like, again, I could tell you a nice story about that, but do I have any idea? No.
And I, this answer could be complete bullshit. I mean, maybe actually it's been the most effective response ever. And,
Right.
the vaccine triumph, the triumph of, developing this and rolling it out in 12 months' time is unbelievable. And it is, right? This isn't an argument or a debate about whether the response has been effective. What I'm saying is how much more or less effective have things been as a function of this related phenomenon. That's all.
Yeah.
So I don't know yet how one can quantify it, but we've got some ideas for that. But I will say that we can look at the frequency of certain kinds of global health events and declarations, and then we can look at the macroeconomic impact in some time window after that's happened. We can look at that historically, and we can focus underwriting or pricing or transferring the risk associated with the economic fallout rather than the binary event of a global health event being declared, right? I think that a big point that we've become increasingly convinced of is that the over-rotation on the naming of and risk modeling of the trigger peril, I think, is attention that should be paid elsewhere to the mid and long tail economic impact and human impact of those events, not in a physical event, like not in the person who's gotten sick, but rather in the business owner and the employees who've been impacted by the government shutdown because everyone's worried that more and more people are going to get sick. That's a secondary peril.
Could you talk about that a little bit more? So you're saying de-emphasize the naming, right? So, like, almost undiscretize these events, because I think like the naming. What's nice about that is that you can
being agnostic about it. Being is so one of the important questions we're asking ourselves now and modeling out is there really truly in this product that we're talking about here, which is really economic catastrophe cover,
right?
Is there a qualitative or quantitative difference in a single named peril or an all peril product? Do they function the same? Right? Because really all we care about is when there's been a macro drawdown and some event up front has happened. There may be one of those events for a given region, like a hurricane, that's more and more frequent, and we can see what the impact is on the gross economy of a region, and that can serve as an initial trigger. But when we tally all of those different events up across multiple categories and then look at when a macroeconomic drawdown has been affected and where a parametric trigger would be activated, do we care? Or do we only care how frequently that macroeconomic event has happened and how severe it's been? Does it almost not matter what the trigger cause has been? Because the impact it's having on people is equally severe, irrespective of what's caused it in the first place. Maybe that's an intellectual or abstract argument.
Well, I don't think so, actually, because I think it's actually a really important point. And let me sort of give you what my kind of like summon the insurance industry conventional wisdom here into the conversation. So I'll say that typical insurance person would say, well, the customer doesn't care, but moral hazard says I should care, because if every time the customer trips over a break in the sidewalk and then claims on me, or for that matter, just takes the money and invokes, the clause saying, oh, there's no definite event here, but this year I kind of had a bad year, so I'm going to take your money. I'm going to submit a claim, right? For if you don't have a tight definition for an event, you expose yourself to moral hazard, right? And so I've had experience in my own career designing stop loss products, which is a version of what we're talking about here. And in the end, you kind of have to de-risk it somehow, else they'll just nick your wallet. Or it's merely a promise to litigate, right? So you might say, there's one famous deal in reinsurance business for systemic cover, which is another version of this. And it was like a 3 or 4 page definition of loss, right? And effectively, we joked amongst my former colleagues, this is just a promise to go to court because nobody's ever going to agree on anything here, right? So
Yeah.
react to that.
So the effort we're taking is to look at the scenarios you describe as the things we want to avoid. We don't want to insure ineptitude. We want to be protected against moral risk or moral hazard or social inflation. And we think we've got some mechanisms for doing so. One, we look at that broad peril universe and broad peril set and look back over history and look at the frequency of breach across one or some combination or all perils. We then look at two, and so that serves as a first parametric trigger. A secondary or second parametric trigger is macroeconomic drawdown. When those events have happened in trigger one, what has been the macroeconomic impact as measured through things like Purchasing Managers Index or consumer sentiment or GDP growth or tax receipts? Okay, you're starting to narrow basis risk. However, that's still way too broad a brush for parametric payout for a business that could be covered when 1 and 2 have been breached. There's still too many actors who have not suffered a loss. There's still too many people getting a benefit who don't need one, and the inverse is also true. So then we go to a third trigger, which is macroeconomic or industry-specific data. When there's been a trigger breach, when there's been a macroeconomic drawdown, what has been the impact on a specific industry or subsector within an industry, as measured through revenue growth, profitability, margins, or industry-specific metrics like miles driven or passenger seats flown or room nights booked or average revenue per user. Okay, you've narrowed basis risk yet again. And if we do that by geography or region of a country, you can go even further. So at that point, you've got a fairly effective narrowing mechanism that's parametrically focused where you are eliminating circumstances. Now, within that, could someone pad their losses, right? It's like when companies restructure in a bad quarter in a down market.
Yeah.
So someone would be paying for the privilege to do that, as in they'd be covering a larger amount and would be paying a larger premium. Would that ultimately lead to a bigger payout for them as they pad their losses? Yes. So then you can go to a fourth trigger, which is either another parametric or a hybrid indemnification. The fourth parametric would be, okay, we're going to look at your company-specific data, and we're going to look at how it's performed vis-a-vis the industry, sub-industry, the broader macro environment, and the trigger environment. And we're going to essentially determine that we're going to ensure that your business is also similarly responding during a down market. But because you've aligned with everything else, what we're doing is making sure that we're not paying you for a company-specific episode. What we're paying, or for management ineptitude. We're paying you, now again, there's still some basis risk there, right? Because you could have maybe effectively managed your way out of this, but you chose not to because you knew you were going to get paid out on your claim. I don't know. The hybrid indemnification would be literally enabling an audit of financial statements or business performance metrics when a claim is filed to ensure that the diminished performance is a function of not extra charges or writing off inventory when in fact you didn't write it off, etc. But you literally have an audit. That is a much heavier lift from an implementation standpoint. But if you do want to get obsessed about eliminating that basis risk to the extent possible, that would be the structure to do it within. we like the pure parametric approach because it's
Yep.
lighter weight and it means that we're willing to live with some degree of basis risk. But I think large scale fraudulent behavior would be more difficult under the regime I've described.
So you got a pretty sophisticated understanding of how all this works, David. I can attest. Now, I'm curious, and we have to close on this because I think we're out of time here. But has this surprised you? I mean, you have done a pretty good job articulating the complexity of the different trade-offs in designing insurance products. Going into it, I imagine you weren't aware of kind of how that you probably wouldn't imagine yourself recreating all this complexity, I would think. So tell me about that journey you've been on and learning about insurance.
Um, Not that I've been on a journey, because I've been in the same chair for a year. um, I feel like it's come to me in a lot of ways. And what I mean by that is, we've put something out there, and because everyone's literally in their chair on their computer, the feedback has been really, really fast.
Hmm.
And the barriers to getting kind of meetings or conversations set up has gotten, the barriers have gotten much lower. Things are happening much more fluidly and much more quickly. And I really like it. I don't think that's a function of the insurance industry. I think it's a function of the time within which we're starting the business.
Interesting.
So that's been really refreshing. I am an insurance industry novice. I have I won't say I have a reverent approach to the industry. I have a respectful approach. There's a lot of capital here and there's a lot of expertise, and there's a reason things have been done the way they've been done historically. I just feel like we're in completely unprecedented territory, given the nature of society. Risk is different now.
So, are you hiring? What can you even ask for the audience? Tell me how I can help you, David.
Um, the simple answer is yes to everything: customer, partner, underwriter, engineer, capital provider, cedent, broker, blogger, skeptic, patriot, lover, fighter. I mean, anything. I mean,
Come one, come all.
well, there's no such thing as a bad intro or a bad connection. Like
Sure.
serendipity plays a massive role in entrepreneurship. You just never know where it's going to go, and you just got to kind of be open to it.
Great. My guest today is David Soloff. David, thank you so much for your time.
Thank you. This was awesome.